We're here today to talk about how financial statements link together. We're talking about relationships of financial statements. Welcome to Accounting How To. I'm your host, Carolyn Grimm. Normally, I would be introducing my sidekick, Terrence, at this point in time. However, Terrence and I are having some relationship problems, and I thought it was better for me if he took the day off because sometimes he really hurts my head. That's all I'm saying. So let's dive into how financial statements work together. Now, financial statements get prepared in a certain order. We're going to take them out of order for a moment. We're going to start with the balance sheet. So the balance sheet shows us what we own and what we owe. And we either owe to a third party like a bank or a vendor, or we owe to the owners. And the balance sheet shows us exactly what we always talk about with the accounting equation, assets equal liabilities plus equity. And since I don't have Terrence to help me today, instead I've brought along a character I like to call Tired Accounting Girl. She may represent somebody that you know. That's all I'm saying. So when we're talking about the balance sheet, we go through our whole accounting cycle from the previous month, and we end up with a post-closing trial balance, which represents our balance sheet. It ends up with just the balances in our assets, our liabilities, and our equity accounts. So that beginning balance is like, it's that peaceful moment when all is calm as the clock strikes midnight on the new month. And then suddenly the peace evaporates because stuff starts to happen again, right? Stuff is always happening in business. It churns and it churns and it churns. We're buying stuff, we're selling stuff. It's all going crazy. And when that stuff happens, all of those transactions, that activity, that's the information that ends up on our financial statements that show us changes. So we're looking at our income statement. For large businesses, they may have a comprehensive income statement as well. We're looking at our statement of cash flows and our statement of owners or shareholders equity. So those are all the financial statements that are keeping track of those changes as we're furiously doing business every day. And then when all is said and done, we end up back at our peaceful ending balance sheet and all is well. So let's dive into that stuff happens section next. So here we are in our income statement. Our income statement shows us revenues and expenses. When we take our revenues, we subtract our expenses, it shows us that we either made a profit, a net income, or a net loss. So when we start the new month, we only had balances in our assets, our liabilities, and our equity accounts because we closed out our revenue and expenses accounts when we did our closing entries that led to our post-closing trial balance, which is our beginning balances for our balance sheet. So in the new month, our revenues and our expenses are at zero. So the income statement is our scoreboard, and every new month is like a new ball game. So we're coming back to zero, and then we're going to count up from there. So we start out with these zero balances in our revenues and expenses, and then stuff happens. We make stuff, we buy stuff, we sell stuff. All this stuff is going on. And then at the end of the month, we sit down and we tally up how the game went. We say, did we have revenue? Did we have expenses? What's the difference between the two? So that gives us our score for the new month. Now that information is what we need in order to do the next piece of our financial statements, which is the statement of shareholders' equity. Because when we have an income or loss in the business, it either increases or decreases the shareholders' equity. And then once we do our statement of shareholders' equity, that will flow into our ending balance sheet and we'll end up back at our peaceful ending balance sheet point. But wait, there's more. The next piece of our financial statements and their relationship with each other is that statement of shareholders' equity. Now, if you're taking accounting class, this is something that you will be preparing as you're doing your financial statements. If you're using a software program to track your accounting, this is going to happen in the background, and you may not even know that it's going on. but it is. So what a statement of shareholders' equity is doing is it is tracking the changes in shareholders' equity. So if you own a business, you want to know whether your equity is going up or your equity is going down. If you are a stockholder in a publicly traded business, you want to know what your share of the value is in that business. So what we're going to do with the statement of shareholders' equity or the statement of owner's equity, depending on the type of business, is we're going to track the changes. So those changes would start with our beginning balance from our beginning balance sheet, and then we look at, does it go up or down? An investment by the owner puts money into the business, the owner's equity goes up. If the owner takes some money out, there's a distribution, there's a dividend, then the owner's equity is going to go down. If there's a net income, the owner's equity increases. If there's a net loss, the owner's equity decreases. And then, depending on the complexity of the business, there may be something called other comprehensive income. And that's income that is outside of our normal operating activities. When we look at all of those changes, we take our beginning balance, we add, we subtract, whichever way we need to go, and then we come to our ending balance sheet balance, and all is peaceful and good. And that brings us back to our balance sheet. So now we've done our income statement, our profit and loss. We've done our statement of changes in owner's equity. And now we are back at the balance sheet where we're going to combine all of this information. We've got our assets, we've got our liabilities, we've updated our equity, and now we can end the month knowing exactly what our value is in the business. We know what we own, we know what we owe both to third parties and to our owners. So once we have done all of the regular accounting things, we're going to do one more financial statement. We want to know where our cash came from and where our cash went to. So we're going to do a statement of cash flows. And we're going to start with our ending balance sheet, but we only want to know about one account. We want to know about our cash. What happened with cash? Where did the cash come from? Where did the cash go? So we're going to divide that into 3 sections. We're going to look at operating activities, investing activities, and financing activities. And when we add all of those increases and decreases together, we can see whether our cash overall increased or decreased. So when we pull all of those pieces together, we start with our income statement. That gives us our net income or loss. That flows into our statement of shareholders' equity. That updates our capital balances and flows into our balance sheet. So now we know our assets, our liabilities, and our equity. And then that flows into our statement of cash flows. And the 4 pieces together give us different pictures of the business that add up to a pretty clear picture of what's going on. And once all of those financial statements are done, that is the moment when Tired Accounting Girl gets to take a nap. And there you have it, the relationships between the financial statements. Until next time, stay balanced, my friends.